Just quickly, is there anything that you think could reverse the recent slide in the shares in the near term? Well, I think we need to see, at some of the elasticity gonna respond, and we need to see the work. I think what's happening at Tesla effectively, they're growing. They need to, on our numbers, they need to grow 30% random to actually absorb the fixed costs they built up to make more cars. So for them right now, they're in a phase where they need to get a growth, because that voice being a fixed up being a headwind, and that volume growth also gives them an edge to reduce variable cost. But I think it's an ongoing process, and then of course the IRA subsidies will start, kicking in, and will help as well. But I think it's Tesla has always been about affordability. For a while, they were expensive cars. They were seen as premium cars. Their mission at Tesla is to make cars more affordable. So right now they're cutting a price to improve affordability. You need to get the cost to follow, and whether it's commodity cost or volume leverage, all that is going to contribute. We just don't know exactly when the trough will be when we start to be looking. Tesla stock has just been here with the downgrade, and the underlying cause might be inescapable for the electric car giant to tune in and hit insights from a top industry analyst that you don't want to miss out on. Wall Street is getting more and more bearish on Tesla after the company went through multiple rounds of price cuts, which ultimately hit its gross margins. Jefferies analyst Philip Schwat is one of 7 analysts to downgrade the stock, and he joins us now. It's great to have you here with us today. When you look through this most recent quarter for Tesla, dig into the numbers, and ultimately come out to the street. Hey, something's going on here. Not happy about it. What is alarming to you most about the company? Well, I think even though there was no domain scenario, there was a scenario that maybe one would be either traffic margin, and from there we can see an improvement. I think what weighed me a little bit is when the CFO who told us early March that there would be 20 gross margin, they missed by 1 point, all happened in the last few weeks of the quarter, and it seems like a lot of it seems to have been pricing, and we saw initially a lot of elasticity response to the price cut, and he seems to have kind of softened as the quarter progressed, though there's a question mark still around how responsive demand is to the price cuts that we're seeing right now. I believe it's July. What is the demand problem? Is it competition? Is it just that the Tesla isn't as appealing as it once was? What do you think is going on? Well, we think part of the reason we decided to downgrade the stock is we look at the proxy is very, very impressive. Yes, there is competition, but there was always going to be competition, and as is most confirmed, that we should be looking at Tesla as a market share progression in autos, not just the world of EVs, because they have to lose share, and EVs otherwise there's no EV transition, so that's itself. But I think I look at Tesla, so it's a very much an engineering-driven, technology-driven firm the way they operate, and maybe they've been a bit lighter or less competent in terms of thinking. What does it take to keep a consumer product alive? How do we manage transition? How do we, was it the offer in a way? And how quickly do we bring in refresh of the models or new models to expand the range a little bit? And I think that as the market softens, we have more recessions, fears affordability is a concern, then you've got a bit of an air gap, I guess, in the other growth trajectory of Tesla. Several Tesla bulls have been taking advantage of the ultimaker's low share price and are buying more shares. Even Cathie Wood's firm ARK Investment recently spent an estimate of $29 million on more than 190,000 Tesla shares after Tesla sank 4.3% following a downgrade. The total worth of ARK's purchase was around $29.36 million based on Tesla's stock's closing price at the time. However, many see this as a buying opportunity. Jefferies' managing director, along with several other analysts, might not share this thought, as they recently downgraded the stock despite Tesla meeting Wall Street's estimates in Q1. What could Tesla be doing wrong? Stay tuned as we dive into more details. Hey guys, welcome back to Tesla Tomorrow. Tesla is an automaker that has made impressive strides selling EVs over the last 2 years. The automaker is starting to produce extremely impressive EVs, as well as its success, which has spurred other manufacturers' interaction. However, the Tesla investment story hangs on high expectations and low probability outcomes. And until the bears are proven wrong, not everyone is fully placing their trust into the car company. Even investors are starting to wonder what annual production or autonomous software success. The share price is already pricing in. Jefferies analyst Philip Hoke is also one of 7 analysts that has recently downgraded their Tesla stock. According to him, while Tesla's products are impressive, the ultimaker still needs to lose market shares in EVs. Why has he said this? Let's find out. But before we start, if you like this type of content, hit that like button, subscribe, and stay tuned to keep up to date on everything going on with Tesla. According to the Jefferies analyst, part of the reason the firm decided to downgrade Tesla's stock is because competition is inevitable for the car company. He stated that investors should be looking at Tesla as a market share progression and not just the world of EVs because the automaker has to lose share in EVs, otherwise there will be no EV transition. Tesla recently missed Wall Street forecasts for the first quarter. Revenues reported a drop in gross margin from 29.1% to 19.3% after a series of price cuts. However, in response to this, at Jefferies, Analyst dropped the firm's rating for Tesla from a buy to hold. Philip cut his Tesla stock price target to $185, down from $230, stating that the firm's decision to hold remains pending a reset of performance and possibly governance. Jeffrey stated that Tesla's strategy of pursuing growth at the expense of margin has its logic and resets expectations. However, the investment bank questions whether Tesla's profit edge was structural or just a timing difference besides cutting its price. Park Jefferies trimmed its forecast for 2023 full-year share revenues by 7%, as well as earnings before tax and interest by 32%. The firm stated that Tesla's first quarter results did not validate the demand elasticity of setting lower prices, adding that cost programs may take longer to materialize. Musk had said during the first quarter results that Tesla is likely in a uniquely strong strategic position because the company is the only one making cars that could technically sell for zero profit for now and then yield tremendous profits in the future through autonomy. Tesla delivered 75,842 Chinese-made EVs in April, down 14.7% from March, according to data from the CPCA. The figure was a huge jump from a year earlier, when Shanghai had its lockdown in April last year. The company delivered only 1512 Chinese-made Model 3 and Model Y cars in the world's largest auto market. Tesla has cut prices in several markets globally and kickstarted a price more than 40 local and international car brands have joined in since the beginning of the year. But price cuts have lowered the automaker's earnings, with Tesla reporting a 24% plunge in the first quarter net income, even though its quarterly global deliveries reached a new all-time high. To some, these price cuts were a sign that EVs from traditional manufacturers like Mercedes-Benz, Volkswagen, or Ford were becoming more viable. Musk told investors that the markets for Teslas were extremely elastic. According to him, even small changes in the price would have a very big effect on demand. This gave hope to a lot of investors, and many of them believed that when coupled with falling costs in materials like lithium, the increased scale that resulted from high production would result in little or no degradation to gross margins. However, the elasticity that Musk has claimed to be seen was either not real or something that happened in March that prevented it from developing. It turned out that Tesla couldn't sell every car it made despite sequential price cuts of approximately 10 to 15%. Deliveries grew by only 6% sequentially. In fact, Tesla actually overproduced in a quarter, thereby growing its inventories, while Tesla and Musk could already be playing a role in alienating prospective buyers. It's worse that more legacy automakers and startups are racing to get new EV products to the market. Vince Palomares, product management principal at Global Mobility, recently stated that down the road, Tesla's hold may not be as strong, even though in the short term the automaker has built that up because it has the infrastructure and the brand recognition. Palomares stated that while Tesla will have that hold on the buyers, he does not expect it to be as dominating going forward. He added that based on what they're seeing for future production plans, he predicts that there will be some kind of erosion to Tesla's share. Selling cars is a hard business already, and Toyota, Volkswagen, and others will not gleefully cede market share. Tesla has to keep refreshing and expanding its product line just to stay still, and its economies and economic realities will get in the way of all product roadmaps for manufacturers, including Tesla. It's worse that EV demand today is limited. Recent reports actually claim that about 85 to 90% of all car sales this year will still be ICE, even though it is possible that this number will fall to 50 by 2030 and even 25 by 2035. While government edicts might be required to force people to buy EVs, these market share figures probably won't be too far off, according to Philip. What is unique and important about Tesla is the model concentration, which involves trying to get the maximum amount of market share out of a relatively concentrated lineup. He stated that the need to expand the model lineup to cover more of the market, manage the life cycle, and also keep the products going better, and develop tools to basically have a smoother progression in growth, cash flow, and earnings. And he also added that while Tesla's mission is to make cars more affordable by cutting prices, they also need to get the cost to follow. According to the analyst, Tesla investors need to see some of the elasticity to respond. He stated that while Tesla is effectively growing, they still need to grow 30 per annual to actually absorb the cost, which are fixed and are what they've built up to make more cars. It believes that Tesla is in a phase where it needs to get growth in order to avoid being a headwind. In his words, volume growth also gives Tesla an edge to reduce variable costs, and probably the IRA subsidies will start kicking in, and that will help as well. And he may be right. Cheaper cars are very likely to actually bring about more demand in the future, and with the looming inflation, more people will be looking to get better and cheaper cars for a lower price. However, these recent distractions may be no more than a temporary blip, and the drop in Tesla's revenues, gross profits, and EPS may only be a minor setback. Maybe interest rates will somehow be rekindled in their products, and maybe the price cuts will start working. Maybe something else happens that investors just haven't thought about. No one can tell, but investors remain hopeful. What do you think about Philip's comments on Tesla? Let us know, and don't forget to tell us what your evaluation of Tesla is. If you want to know more about what Tesla's been up to over the last few days, go ahead and click on this next video on your screen. See you there.